Okay. Good morning, Wave, if you can hear me. Anyone can hear me? Okay, thanks a lot. Good morning. We will have people jumping in here during the next couple minutes as we go along. This is the first time we've done Pat Stats entirely on Zoom, and I think everyone is realizing we all have to stumble through some of the technical issues and figure out some things during the course of it, but we're getting slowly better. My name is Carson Brooks. I'm the broker and manager for EXIT Realty Metro with 3 different offices, but this program is for many more people than just our team. And we have been doing these quarterly for just about 10 years. And it's quite a thrill to have someone like Pat Paulson in our midst. And I am very excited because many of you know his background. He comes out of accounting, been an avid student of all things about the economy, locally and nationally, and particularly delving into the local real estate market in the Twin Cities on a daily basis. And added to that, the fact that he's been an active, involved, and engaged realtor in these markets during that same period of time, which is probably 30 years, he sees on the front lines what is happening to add into his study. In addition to the fact that he's seen at least 5 recessions and market shifts over time. So today and in 2020, it's never been more important to look at the market and look at what's going on with the COVID-19 challenges and all the shifts that we are seeing in many, many areas and how we might be prepared. Because as I said to our team yesterday, we don't lose our jobs when we're in real estate. We have to adjust and work with the changes in the market and the situation. So I am proud more than ever to work side by side with Pat, and want to turn this over, and we'll make sure that everyone is muted so that we can listen and hear Pat as he goes through his presentation on what's happening right now at the end of the first quarter of 2020. Pat?
Okay, am I unmuted?
Yep, you're good.
Okay. Thank you very much, Carson, and thank you everyone for joining us. And we've been doing these for a long time. Carson mentioned 10 years. I've actually been doing updates for probably about 25 years or so. First time on Zoom, and obviously under very unusual, very different circumstances with the COVID-19 situation, which has prompted me to really add some significant changes to what I regularly talk about during the update. And so I'm taking a look in here on some past significant events that have happened over the years and trying to determine how they've impacted the market. So what we're going to do is we have everyone muted, so we're not really going to be taking questions through the slides. We'll use the chat function and address questions when I'm done, in part because I'm hard of hearing, so I can see better than I can hear, so the chat is going to help. And in part because I got 50 slides to go through, so I want to get through these as quickly as I can. We could obviously talk about the material that I have in here for 2 or 3 hours, but we're going to try to keep it under about 45 minutes. So let's move forward. One of the things for me that's important in uncertain times, and these times are more uncertain than any that we've known, but we always have some degree of uncertainty. And predicting the future is, there's never any certainty involved. But what I like to focus on are the things that we know. So I think of that as a good starting point. If we become knowledgeable about the things that don't change, then we're kind of prepared with a foundation, with a starting point to really analyze things as changes come along. So what do we know? So this is where we always want to start. And my last presentation in January, I actually ended with a few things that we know, a few things that we don't know. And so we're going to actually start with those with this presentation. So one of the things we know is the law of supply and demand is real. And that's very evident when we look at the real estate market in the Twin Cities over the last 20 years or so. We know that increasing money supply, strong economies, low unemployment will lead to inflation, and that the bond markets will respond to that by raising interest rates. We also know that there are very powerful anti-inflationary forces that kind of hold inflation down, and these have been growing in power the last couple of decades. So globalization and technology have helped to keep inflation low, and consequently, interest rates have been dropping for the last 20 years or so as a result of these. We know that the market downturn in 2007 through 2011 wasn't just preceded by historically high prices. A lot of people think, market bubble, the bubble had to burst, but it was also preceded by very high inventory levels and a lot of subprime financing that led to a lot of foreclosures. Those two factors, the high inventory levels and the subprime financing, are not part of the current market. So even though we're also at all-time highs price-wise, we don't have those other factors in the market at this point. We also know that migration to urban areas, which has been going on for millennia, continues to fuel housing demand in the Twin Cities and major metropolitan areas. What we don't know, so Twin Cities market has had really high sales rates the last 4 years, near all-time highs. And so we're not entirely certain whether all those sales has basically exhausted most of the demand, if most of the buyers of this cycle, of this era, have bought already, or alternatively, we've had very low inventory for the last several years, and we don't know if there's maybe a lot of demand still out there, people that weren't able to buy a home. They wanted to, but they couldn't find what they wanted, and or lost out in multiple offers. So we're not entirely certain how much demand is out there or was out there prior to the COVID crisis. The other thing we don't know, and of course this is in January when I did my January presentation, we don't know or didn't know other outside influences that may be lurking and could impact the real estate market. And now, of course, we do.
Lurking.
Yes. So impact of COVID-19, entering the crisis and working through it. First off, March stats, I don't think the official numbers are out yet. Preliminary numbers are out and they were very strong. Despite the declaration of emergency, despite the shutdowns, March had strong numbers. The first quarter has been very strong. So if we look at activity, new listings, this is for the first quarter of 2020 in the Twin Cities market, up 12.9% from last year. I do want to point out that last year, February and March, if you all remember, were very bad weather months in Minnesota. And so it's not a surprise that the market was down last year. But this year is even quite a bit higher than the year before. So the start to this year was very strong. Pending activity, same thing, up 12% over last year for the first quarter, and up quite a bit from the year before as well. Sale prices, 297,000. We are poised to go over 300,000 for the first time, most likely in April. So prices are doing quite well. But if we look at the most up-to-date data, and I really want to do a shout out here to David Arbit of MAR. He's really stepped up and has been analyzing the activity of sellers and buyers on a daily basis, showings as well. So if we look at the most up-to-date data, we can really see the impact of COVID-19. Showings had been, right before the shutdown started, had been up to over 4,000 per day, a lot of showings. They dropped down to under 2,500 a day, okay? Still plenty of showings to sell a lot of houses. but down to January levels, basically. New listings. So we're looking at a rolling weekly average. The average per day is a little over 150. This is down quite a bit over the previous 3 years. Okay, so we've got in the black is the 2020, and you can see how it's dropped off since the market shutdowns. It has not stopped by any stretch of the imagination. These are new listings per day, down to about 100, 150. Normally, you're going to see 250 or more per day. So actual pending sales, these are purchase agreements entered into and accepted. 2020, again, has dropped off the last few weeks. So we're down to about 140 per day. Normals, probably 170 up to almost 200 per day. So the market has slowed down, but it has not stopped. So let's look at the underlying market conditions. And for those of you who are familiar with my presentations in the market, I really do take a look at market cycles. I look at the longer term cycles and try to evaluate the current market as to where we are within those cycles. And so I'm always looking at the underlying market conditions. What is important to me is what I call kind of the inner market dynamics, the way markets work, the way systems in general work. So you have supply and demand, and you've got prices, and you've got affordability, and those things all kind of interplay with each other. So looking at actual supply, and this has been the story of the market for the last number of years. So this is the number of homes for sale, and classic market cycles here. We were at extreme highs back in 2007, 2008. You can't see the chart all the way to the left, but if it were extended to the left more, numbers were actually very low in around 2000, the late 90s, 2000, and then they went up, and then they've come down, and this is kind of a classic example of the long-term market cycles. So this is the number of homes for sale. We're actually more interested in a supply-demand ratio, so we're going to look at months supply, and you'll see the next chart looks almost exactly like this chart. So I'll switch the page, very similar. And so again, we have a very low supply-demand ratio. We're at a little over 2 months supply. And you can see as well that these numbers have been dropping for about a dozen years. Okay, so since about 2008. You can see right in the middle of the chart in around 2012, it dropped down below the 6-month level. The important point is 6 months is approximately what people think of as a balanced market, a balanced supply-demand ratio. And sure enough, on the way down, as it passed that point, the 6-month point, prices stopped dropping, they hit the bottom, and then they started going up. And so that's been the story of the market. It's been this low supply-demand ratio pushing up prices. Now, over time, this is going to change. And what typically happens is when you have a market like this, and the way market cycles work, is that you've got a low supply-demand ratio that puts upward price pressure. Eventually, prices get high enough where buyers start to drop out of the market, sellers start to jump in to take advantage of those high prices, and then the market shifts and the supply-demand ratio goes up, okay? Now, as a result of COVID-19, it's a very real possibility that we're going to start to lose buyers. People are losing jobs. So losing buyers is a very real possibility. What normally would happen as prices go up and buyers start to drop out of the market, that may accelerate here a little bit. Also, seller activity might begin to pick up sooner than expected because of financial strain on a lot of sellers. So we may start to see some distressed sellers wanting to put their homes in the market. So we could see an acceleration of the coming cycle change. So we could see that the supply-demand ratio starts to rise a little bit because of increased seller activity and decreased buyer activity. And we could see this chart start to change. The point I want to make is that this does change, it will change, but it doesn't change fast. We have very low supply. It's going to take some time for it to build up. And when I say some time, I'm not talking about months, I'm talking about years. So even, with the huge impact of COVID-19, it's going to take some time for this to build up. Here, of course, we have prices. We see the peak back in 2006. We see the decline during the foreclosure crisis. And we see where it hit bottom in 2012, and it's been going up ever since. This chart shows affordability. This is very important as well. Affordability index takes into consideration price, median income, and interest rates. And what it tells us is when it's at 100, that means the median income household can afford the median priced home at today's interest rates. If you look back more than 15 years, it's never been below 100. Twin Cities generally tends to be more affordable than most of the places in the country, most of the major metro areas. At the price peak in 2006, it dropped down to 111. In 2019, over at the right of the chart, the last blue line, it was at 143. So here we had in 2019, we had prices that were 50,000 higher than they were in 2006, yet housing was more affordable because interest rates were so much lower and because incomes were higher, okay? Now, if you look to the right of that in the yellow, we have projections. So if prices hit 300, which is possible this year, and if interest rates are at 4%, they're actually lower than that now, the index will be at about 138. And in a year or two down the road, if prices hit 325 and rates are at 4%, this drops down to 132. The point is, it's still affordable. Now, I want to stress that for a lot of people, it's not affordable. For the median income tenant, it's not affordable. But generally speaking, relatively speaking, it's more affordable than it was during the last price peak. And so this kind of tells me that there is capacity for further price growth. So the low supply demand ratio that we have had and have right now that's pushing up prices, there's room for more price growth. So all of this that I've been talking about, supply, demand, price, affordability, I kind of consider that intermarket dynamics. And I'm going to look at just overall influences on the market. So those are kind of within the market, the way a market works, the way cycles work. Constant interaction, balancing between supply and demand and price trends and affordability. This is a longer look at supply and demand going back over 50 years. The top line are new listings each year. The bottom line are the number of sales each year. And if you look right in the middle of the chart, in the 1990s, the number of new listings coming on the market were dropping and dropping and dropping. At the same time, sales were increasing. And as we got towards the end of the 90s and right around the turn of the century, right around 2000, almost everything was selling. And so it was a tight market, and that put a lot of upward price pressure. Then you see with the rising prices, sellers start to jump in the market. Listings go up all the way up to their peak in 2006. Eventually, when prices get pretty high and when all the sellers are on the market, it gets harder to sell. All of a sudden, the market starts to crash. Buyers start to drop out of the market. Prices start to go down because of all the foreclosures. And there's a big spread then between the lower line and the upper line, and prices start to fall. Sellers then can't sell, and so they stop trying, and then seller activity drops. Eventually, prices bottom out in 2012. Buyers, particularly investor buyers, start to jump back into the market, so buyer activity increases as we're way over to the right of the chart now, and the market gets tight again. Everything's selling and prices start to go up. So This is kind of a good example of how market cycles work and how the supply-demand ratio really impacts what's happening with prices. This is a chart going back to 1960 showing the average sale price during that time. I'm going to get into this in more detail. I'm going to actually cut this in half and talk about each half major events that impacted them. But you can kind of see the cycles over the years showing up in prices where the market went up substantially in the 70s during a seller's market. It kind of flatlined for much of the 80s, or the increase was very much less. There was actually a hidden crash that you can't see on this chart that occurred back then, but that's another discussion for another day. Then you can see the market increasing again in the late 90s and the 2000s, and then the big crash after 2007, and then the recovery since then. So a good demonstration of these longer term cycles. So let's talk about major events. So in addition to the inner market dynamics, supply-demand ratios, outside events can oftentimes have a significant influence on the market. And I want to stress that there are always, at any point in time, there's multiple factors that are influencing the market. So it actually makes it hard to determine how much of an impact any one factor has, because there's many things going on. Some are more noticeable, some are less noticeable. Right now, we're all noticing the COVID-19 impacts, but underlying it all is this low supply-demand ratio, and they're all kind of impacting things. So here's a list of random significant events going back about 100 years, and this is by no means a complete list. This is just some examples. And I'm going to get into some detail on some of these things. So just a few things. Some of these things they were almost all significant newsworthy events that took up the news of the day in a significant way. Many of these things really scared most of us when they happened. Some of them impacted the market, some of them didn't. So let's look into some of the details. And I want to point out some events last so long that they're not even really events anymore. They become kind of a permanent part of the underlying system, the structure. So like the Federal Reserve, and these things are things we just take for granted, but they have significant influences on the market. FHA, VA, Fannie, Freddie, this allows people to get 30-year fixed rate mortgages with low down payments. Without those, and they've been around since the 1930s, without those, instead of 60+% home ownership in the US, we'd be at 30%. So these are huge things, but they're really kind of part of the structure now. But yeah, big impact on the real estate market. So let's go back to 1918, 100 years ago, Spanish flu. And please, when I point out here that it was about 5 to 10 times worse than the projections of COVID-19, please don't interpret this as me, kind of indicating that COVID-19's insignificant, because it's extremely significant. And we don't know how things are going. We're just partway into it. We don't know how things are going to turn out. We don't know all of the economic impacts. We don't know how many people are going to lose their lives. But we do know the Spanish flu took about 675,000 Americans. It took almost 50 million people worldwide that passed away. We know that the United States had about 100 million people at the time, so about a third of what we do now. And even with a third of the people, there were probably about 5 to 10 times as many lives lost as what the projections are for COVID-19. It remains to be seen, but it was a significant event in the US and worldwide. Extensive social distancing was used during the Spanish flu crisis. And the Spanish flu, that's just a name for it. It didn't originate in Spain. It's just that Spain was the the first country to really acknowledge it. And the news was coming out of Spain mostly, so that's what they called it that. But similar to now, of course, now 100 years later, the economy is very different and so forth. But this is an example of social distancing in a tiny town in British Columbia. And this happened all over the United States, all over the world, social distancing. So shutting down of gathering places, very, very common back then. But despite the pandemic, not a lot happened. Well, economically, you know, it slowed things down dramatically in the beginning, but this is overall GDP, per capita GDP. And back in that era, recessions were much more frequent. And there was a recession after the Spanish flu. And keep in mind, this is also during World War I. So very devastating times. But if you actually look at the history of recessions, which I've read through, the two recessions, one right before and the one right after, it doesn't even actually mention the flu. I can't remember, at this point, I forgot what it says. It might have had something to do with the aftermath of the war. But the market, or the overall economy, did drop somewhat. And then it picked right back up again around 1920, 21, and we went into what was called the Roaring '20s, a strong economic time. This is a little bit hard to tell because it's way over on the left of the chart where prices were so low and you can't really see the impact that much, but home prices did not drop during the Spanish flu. They actually did drop during the recession, the Great Depression in the 1930s, but during the flu and the aftermath, they did not. So a quote from the Federal Reserve: the influenza of 1918 was short-lived. The influence was not on the collectives, but on the atoms of human society, of the individuals. So the society as a whole recovered pretty quickly, but it were the individuals that were affected by the flu and had their lives changed forever. And we know, of course, during this time, it's going to be very similar. There's going to be many individuals, many families that are going to be losing lives and losing jobs and are going to have their lives changed forever. So let's talk a little bit about the era from 1973 to 1982. This is a time where I went from a carefree 16-year-old to a 25-year-old homeowner with 3 kids. There were just multiple events that occurred that just flooded the news. Things were scary. There was the Vietnam War. There was Watergate, the scandal. The vice president, Spiro Agnew, resigned. I can't even remember why. They had to appoint a new vice president, Gerald Ford. And then the president, Nixon, resigned. So it wasn't like the impeachment of Trump or Clinton, which were big newsworthy events, but we all knew they weren't going to be convicted. Nixon was forced out. He had to resign. So this was a big, big deal. We lose the vice president, we lose the president, and then we get a new president that wasn't even elected, Gerald Ford. Nice guy, by the way. But major times. Things slowed down a little bit. And then we had, at the end of the decade, we had the Iran hostage crisis, which lasted about a year, constantly on the news. And lest I forget, there were a couple of oil embargoes, major oil crises that occurred, 1973, 74, and then again in 1979. This is what it was like back then if you wanted to get gas in your car. You literally waited for hours in line to get gas. It was just crazy. You'd get up at 5 in the morning and then go wait in line for hours. Cars are idling, wasting gas idling. We were this close to gasoline rationing, this close in that they printed coupons. They didn't actually use them. But these were crazy times. So looking at the real estate market, the events I want to focus on were quieter events, but more impactful. So we dropped out of the Bretton Woods Agreement in 1971, and we switched to off of the gold standard. So we went to a complete fiat currency. Our money was no longer backed by gold. So complete fiat currency system. This, with a loose Federal Reserve, led to significant inflation. If you look at the real estate prices in the latter half of the 1970s, they doubled in 5 years. It doesn't look so big on the longer chart because the starting point, the price range was low, but we had 20% per year price increases. We had the market basically double in 5 years, so it was significant. Inflation with all products was very high. Then came Paul Volcker, imposing man, 6'7" cigar hanging out of his mouth, was appointed to the Federal Reserve. Scary guy. And he came in with the intent of getting rid of inflation. And he did. And he crushed the entire economy, basically. Raised interest rates, prime rate went up to 20%, mortgage rates went up to 16%. So you see in the early 80s, this is what I talked about earlier, a hidden market crash, sales dropped dramatically. Prices of much of the market went down. You don't see it on here, but so very difficult times. It was a recession that was pretty much as bad as the recession of 2008. So very significant unemployment, major impact on the real estate market. Now let's move forward to the next big up and down cycle. And we talked about this already in terms of supply demand and how that impacted this cycle. I just want to add to it the major events that also impacted the cycle. So when the market was going up in the late 90s, early 2000s, this had so much to do with low supply demand ratios. So the market was on fire, but essentially it was like throwing gasoline on the fire. The major event was the subprime financing that I want to talk about. So we had a number of years with subprime financing where they basically decided to give financing to everybody. And the catch was, it was just bad mortgages, adjustable rates that adjusted up substantially after 2 or 3 years. And then all of this was, bundled together and securitized onto Wall Street, and all kinds of toxic financial products were made from this. And eventually when everything kind of hit a peak and you had a great realization that prices weren't going up anymore, and you had all kinds of people with mortgages that they couldn't afford to pay, you saw the market crash, you saw people walking away from their homes, you saw investors giving up on their properties, and you saw the banks and mortgage companies flood the market with foreclosures. So these are two significant events, the subprime financing and the flooding of the market with foreclosures, that directly impacted the market and persisted for a number of years. So these were big players in this very extreme change of the market cycle. So how might COVID-19 impact the real estate market? And we're early in this. I don't know all of the answers. None of us do. We don't know how many more people are going to lose their lives. We don't know exactly when the economy's going to open up. They're trying to figure that out now. But let's just look at some of the things we do know. So underlying market conditions are good. They were very good. We had low supply demand ratio. We have capacity for price growth, as I've discussed. There really is a high level of owner equity. Prices have gone up so much, so the equity in properties are high. And we got really low mortgage financing. So these are all really good underlying market conditions. So what might happen? Possible market responses. And I would expect some of all of this. So people continuing to buy and sell, and we're seeing that right now. In the worst of times, we're seeing 140 sales a day in the Twin Cities. We will have some people that will wait a few months for the shutdowns to end, and then they'll get back in the market. We will have other people that will decide to wait until next year. We will have some potential buyers drop out of the market, period, for this cycle. And we'll have some financially distressed owners become sellers. So the combination of those two things, buyers dropping out kind of permanently and then sellers kind of jumping in unexpectedly and then not buying, so selling but not buying, this could accelerate the coming change of supply-demand ratio, could start to increase the supply-demand ratio and kind of slow down the price increases. And then lastly, I'm going to say changing housing needs, and there's any number of examples. That's worth exploring for all of the realtors listening in. There's, in a crisis environment like this, people's lives change, families change, and their housing needs change. So we're going to see a variety of things. Now, this long-term outlook is really what I've been presenting the last couple of years. Expecting the market to experience continued significant price growth, for a couple more years. Rising prices eventually leading to changes in behavior amongst buyers and sellers, leading to a cycle change. And I believe the coming cycle change won't be nearly as extreme as the last cycle change. So overall, I think we can definitely expect reduced activity this year. I just heard today unemployment filings came out for the last week, another 5 million. There's been 22 million unemployment filings the last few weeks. That's 1 in 7 jobs. 1 in 7 jobs. So there's obviously a huge economic drop. When we get the GDP numbers for the quarter, it's going to be a significant drop. When the economy comes back, when things turn on, we're going to be at a starting point that's really low because of this drop, and we're going to see a significant rebound. This is the overall economy. But the rebound is going to be slower than the drop. Okay. Ultimately, what it's going to end up like, it'll be different. I don't know how much different. I don't know how much of the job losses are going to be permanent. I don't know how many businesses are going to go out of business. The exact overall impact, it's hard to tell. The real estate market in any given year is probably maybe about 4% of households buy or sell during any given year, so it's a small percentage. Many of the people that are losing their jobs are in the lower income ranges and had less stability and weren't going to be homeowners anyway, but a lot of the potential homeowners and prospective homeowners and buyers won't be able to buy, at least not for now, not temporarily. So reduced activity this year, just a wild guess, maybe 10% down. It's kind of like we had a strong first quarter. Now we go into April and it turned into January in terms of the real estate market. And May probably isn't going to be so good either. We may see, a delayed spring market if things open up completely this summer. But we're going to lose some activity this year. There's no question about that. So if we lose about 10%, that means we drop from what might have been 60,000 sales down to about 54,000. That's as good a guess as any. If we look forward, this shows the average sale price in the dark red from 1990 to 2019, and you can see the cycles. And then this is the projections I had over the last year. The dotted lines that follow after that, the straight one on the top is if prices were to continue at the rate of 4%, which has been the average rate all this time from 1990 to 2019. So if it continued at 4%, that's what that top straight line would be. The bottom straight line is at 2%, which is the Fed target rate for inflation. What I have been projecting in recent years has been that curved line that goes up pretty sharply for a couple more years. So my last projection was 5% for 2 more years, and then 3% for 2 years, and then kind of flattening out at a 1% increase for a 5-year period. So my thinking has been that, we're not at the end of the cycle yet. We're not at the end of this cycle, but we're coming to the end in the next few years, and that the cycle change is going to be much less dramatic than the last one, primarily because we don't have those extra ingredients that we had in 2007 of the really high inventory and the really high level of subprime financing. So that's why I think we're looking at a much less extreme cycle change. This circumstance, though, COVID-19, could result in increased distressed sellers, decreased buyer activity to accelerate the coming cycle change. I'm not making that projection yet. We'll see when I come back in July and or October. I'll know a whole lot more at that point. The other thing is, we get more distressed properties on the market and selling, they tend to sell at lower prices. So that will have an impact of kind of showing, the average and median price will kind of show up a little bit lower than it otherwise may have. Again, I don't expect that to be significant enough to start a price decline in the near future. I am not expecting that at all. So, a lot of big questions. We start with what we know, and we take that and we apply to what we see, and we try to predict as best as we can going forward. I want to stress that these charts that I have here, for those of you who are my realtor friends in the Twin Cities, you actually have access to many of these charts. So many of them I got off of InfoSparks. Some of them I just pulled off of, just looked up on the internet. I did get some special charts from David Arbit of Minneapolis area realtors. He's the research director, economist there. We're in communication constantly. I want to give him another shout out because we've had many conversations over the years that have led to these updates. The opinions are my own. I don't have permission to share every single slide that I've used here, so I'm not going to be sharing the PowerPoint. Most everything in here is accessible to the realtors in particular. But I thank you all for joining. At this point, I can take questions via chat.
Let me tell you a couple of them. And Josh is on there. We could ask him to comment on this, but will the change in lending and credit requirements have an impact on our local market?
Can you come a little closer so I can hear better? I'm sorry.
The change in the credit requirements
that
has happened with a lot of lenders, much stricter standards.
Yes.
Do you see that changing the market locally? I mentioned Josh is on here. We could ask him.
Okay. And you're talking about the change previously, like the last crisis?
No, just recently.
Just recently. Okay. So the question is about changing requirements with lenders, and this would be better answered by a lender, and we may be able to add one on because we have Josh Hennessy on here. But just my thoughts on it, obviously that's impacting things. That will impact things if there are more strict requirements. And part of the adjustments that realtors have made in these times, including the precautions, social distancing and so forth, we've created a new addendum to the purchase agreement specifically for COVID. But I don't know if we want to turn Josh on to answer one of those questions. Are you able to?
No, ask him.
Okay.
Just ask him.
Josh?
Hey guys, I'm here. Can you hear me?
Yes, I can hear you. Thank you.
Pat, great presentation. This is really good stuff. I'll just comment real quick on what we're seeing from the lending side. Certain lenders, FHA is probably is being most impacted by what's going on. We've got lenders that Wells Fargo won't lend below 680 on an FHA. I saw that Michael Brennan made a comment. Chase has gone to a 700 plus credit score across the board, no matter what type of program that it is. I think overall that anyone that's below, FHA in the past has gone down to 580. That's now been adjusted up to the minimum score being a 640. I would say a majority of lenders won't do anything below 660. So if that changes, we don't know if that's going to change depending on how this plays out. But my guess is that this is going to be in place for probably the rest of this year. It evolves almost daily in terms of what different lenders are willing to do and not do. So the impact has been pretty severe already in terms of, there's a huge portion of the market that has credit that's not, it's not perfect credit. And we're seeing, a lot of people already that have immediately been taken out of the buying market.
Okay.
Yes.
Thank you.
Thank you very much, Josh.
Another question which you talked about a little bit, the lower level of new listings, is that still going to keep pushing some prices upward in the near future as the supply is dwindling?
Yes. So question about the low level of new listings. And yes, absolutely. That's been the story actually for a number of years. And that's part of why supply has been so low and prices have been going up. And it seems as though this, first month or so of this crisis, that new listing activity has actually, to me, my view is it's slowed down more than the buyer activity. So those really latest charts that I got from David Arbit showed pending sales at about 140 per day and new listings at only about a little over 150 a day. And, if you can think about, sellers, they, for whatever reason, some of them might just think it's a bad time to sell. Some of them to get ready to handle the precautions involved of all the extra sanitizing and so forth relating to COVID-19. They may be, just deciding not to do it or taking longer to get ready. So yes, there's been a slowdown in seller activity. This puts more upward price pressure. There's less houses available. I do think though that it is very possible that in the future, relating to this and relating to financial distress, we may see more seller activity, increased seller activity. But I wouldn't, certainly didn't expect it this fast, and we're obviously not seeing it this fast. But it could be something that's more noticeable later in the year.
We may have a job to assist people ahead of distress to sell.
Yes, and indeed, yeah, it may be, as Carson's mentioning, part of our job as realtors, helping to prep our sellers to be able to sell under these conditions.
Pat, one of the big questions a lot of sellers are asking though is, should we put our house on the market now, in May or June? It's a tough one to answer, but what do you think?
Yeah, so the questions, is that sellers are asking, should we put the house on the market now or May or June or whatever? And, from a market perspective, any of these times are good. So it's a seller's market. Buyer activity is down, no question. But seller activity is down even more so apparently right now. And so the low supply demand ratio that we've had for the last number of years is even almost lower now. So that's very favorable for sellers. The other side of the coin is it's more work for the seller to get the home ready in these conditions. Yeah. And it may be more work on a daily basis to keep it sanitized. So it's really up to the seller. It's kind of like the old question of when's the best time to sell, when's the best time to buy? And the answer is really when you're ready.
There's anecdotal things like there's no place open to donate belongings and clean things up.
Yeah, exactly. Yeah.
Just yesterday, the SBA announced that the funds for small business stimulus have run out.
Okay.
So, we're already seeing some of these helpful measures already depleted.
Yes, that's unfortunate. So if you didn't hear that, the announcement that the SBA funds for small business loans had run out. So hopefully that will be replenished soon.
Any other questions?
Any other questions?
Mike Brennan has some that are pretty detailed that I'll share with you.
Okay. Do you see any there? Okay. Well, that looks like it's it. I really want to thank all of you for tuning in. It's a little bit different doing this via the Zoom message, but glad that we're able to do this. These are obviously very challenging times. Social distancing is not a thing that humans are used to. We're used to being social. And, you know, it's difficult to not see people. It's difficult to not shake hands and not give hugs. And, you know, but we'll get through this. You know, we've been through difficult times before. I'm going to just stress on the presentation the significant events that really impacted the market. The 1970s, the inflation of the 1970s, the high interest rates in the early 80s, the subprime financing in the late 90s, early 2000s, and then the banks flooding the market with foreclosures, you know, 2007 to 2013. I had given a long list of significant events that have occurred over time. But those were the events that really had the most impact on the real estate market. And some of those events were kind of quieter. They weren't as newsworthy. But the common features about those events that really impacted the market were that those were things that have really direct impact on real estate. So inflation pushing prices up, interest rates, we all get mortgages, most of us, subprime financing, and then the banks flooding the market. So those were events that had direct impact on the real estate market. And the other common feature about those were that they all persisted for years. They all persisted for years. So some of the other events, you know, impeachment, 9/11, even a number of recessions that occurred that didn't last as long. They were huge events and they had significant impact, but they didn't last as long. They didn't have direct impact on the real estate market, and they ended up not doing much. The market, you know, would just keep going up or whatever it was doing. So just my observation, I learned a lot in preparing for this this presentation. Observing what's happened in the past shows me the really high impact events persisted for a period of time, and they were really directly related to real estate. So that said, I want to thank everyone. I appreciate all of you. Yep.
Okay, we just want, can't do it. Turn the sound off. I just want to thank everyone. Turn the sound off. Turn your speaker. Okay, just want to say a final thank you to everyone and for participating, and for Pat and all of his research. If you have additional questions, please email them to me or to Pat at pat.paulson@ermetro.com. Again, we do this quarterly, and we are in a time of significant change. As I stated at the beginning, our job doesn't go away during a time like this. We just need to be agile and adjust, and it takes some energy and some work and lots of education. So thank you all, and we look forward to more questions and more dialogue as we work and survive and live through this big change.